All right, we'll just get started. So what is investing? Why are we here? Why does this group even exist? Investing is putting time, effort, and money into something today with the expectation, but not the guarantee, that you'll receive future profits, gains, or income. So the not a guarantee is really important. We are not talking in here about anything that has a guarantee associated with it. Some things that are guaranteed are contracts that you get from an insurance company. They can offer a guarantee by law. Your FDIC insured savings account or checking account is a guarantee that you won't lose money. But when you think about those things, especially think about your savings account, in exchange for that guarantee, what's your rate of return? It's zero, right? It's like 0.01% in your money market account, or the money market's not even guaranteed, in your savings account. So, in finance, in investing, you've probably heard that you have to take risk to have some expectation of return. The challenge of it is how much risk am I willing to take and what am I doing it in exchange for? So most people are investing to reach long-term goals, like retirement, either getting to retirement age. If you are of retirement age or near it, you have to get through retirement, which is long, right? If you retire at 60, 65, people live a long time. It's a long time that you're still going to be making investing decisions. And then if, what we're going to talk about next week, if you have young kids and you have a pretty long time horizon for saving for college, that's another pretty common goal. Are there any questions on that? So if we're talking about retirement, just something to think about, where will you get money for retirement? This is usually at least one of the big goals that everyone in the room probably has. How am I going to take care of myself in retirement? So these are kind of the 2 or 3 legs that you might have on your stool. First, Social Security. You can go to the Social Security website and you can get an estimate of what your benefits might be. So the way Social Security works, as you know, if you have earnings, if you trade your time for money, part of your earnings go to Social Security, right? They're taking your money, they're accounting for it in their system. Some of that money is going out to current retirees. But the idea is if you pay X number of dollars into the system, when you retire, you will get Y number of dollars out of the system. There's always a question about Social Security. It's, we've all heard it's going bankrupt, like it might not be around. My personal opinion on this is if you are near or over age 50, you're probably going to get the benefits that are being estimated at the Social Security website. If you're under age 50, there's a good chance that, our full retirement age will be pushed back from 67 to 70. Or taxes will go up and we'll have to pay in more into the system. I don't think Social Security is just going to poof, go away like it never existed. But for people who are farther away from retirement age, there will be some trade-offs that are going to happen just because of math. So you can go to Social Security and you can get an idea of when you hit retirement age, what your income check will be. And that's a guaranteed check that's sent to you every month until you die. So that's pretty good. You can just kind of keep in mind that Social Security typically replaces about 40% of the average worker's income. So if you're a very high income, Social Security will replace a lower percentage. If you're low income, Social Security might replace a higher percentage. Does that make sense? And that's a lifetime benefit. So you might have a pension. If you work in the public sector, you are almost certainly paying into a pension system. So if you're a teacher, if you work for the state, if you work for UT, if you work for any government organization, you're probably paying into a pension system. This is called a defined benefit plan. So the benefit that you get in retirement is defined by a formula. So here, this is the actual TRS formula. They'll take your years of service times 2.3% times the average of your 5 highest salary years. That is your benefit, as defined by the state of Texas, who put this formula together. You don't really have a whole lot of control over whether you contribute and how much you contribute. They tell you that. And you don't really have that much control over what your benefit is. They tell you that too. So this is a defined benefit plan. Yeah.
So can we go back to Social Security?
Sure.
So if your spouse passes before you, you get some of their Social Security?
There are survivor benefits. There are survivor benefits, there are spousal benefits. You're still entitled to spousal benefits even if you're divorced, as long as you were married for more than 10 years. There are a lot of different rules on the claiming of Social Security. It would definitely be a whole thing in and of itself. But yes. Yeah.
Does the pension take over Social Security? So if someone works as a teacher, for instance, they don't have Social Security, but they do have a pension, right?
It depends.
Okay.
It depends.
Okay.
There are some people who pay into a pension and will have reduced Social Security benefits because of that.
Okay.
Sometimes you pay into both, and so you would get both benefits.
Okay.
So it depends. If you are paying into a pension, you would want to know if you're also paying into Social Security.
And you would know that by looking at your paycheck.
Right, and you would also, if you work for a school district, that's usually where this comes up. You've paid in as a teacher into a school district, and then you get to retirement age, and they're like, oh, you haven't been paying into Social Security this whole time, so you just have your pension benefit, and you have a reduced Social Security benefit. You want to know that in advance.
Yeah. Could you actually make sure that you put money into Social Security?
I don't think that you can make voluntary contributions.
Okay.
Boston ISD does not. When I haven't worked for the district in like 7 years, but when I worked for the district, there was no Social Security at all. And then you weren't fully vested in your pension until 5 years.
Yeah. So you'll want to check on all these rules, and they're all different, right? The pension that is set up is specific to the employer, so call them. Yeah.
Typically then with pensions, is there a point of exhaustion in terms of where you wouldn't get that benefit, or does that continue?
That's a really great question. You're not supposed to. There's not supposed to be a point of exhaustion.
Okay.
The way it's supposed to work is all the employees have been sending in their contributions.
Right.
Those contributions are being invested, and some really smart person is doing calculations to say, all right, these are all the benefits that need to be paid out now. These are all the benefits that need to be paid out in the future. The state of Illinois, I'm from Illinois, the state of Illinois, this is like a huge, huge problem where the people who are expecting benefits might not get them, right? Where the money has to come from somewhere, right? So in Texas, our major pension plans are in good shape. They've been managed responsibly. But there are a lot of places where that's not the case, and future benefits either go away, they get reduced, they get changed for new employees who are coming into the system, because the money has to come from somewhere. If there's no money, then there's no pension payout.
Right. Yeah, as I understand, so TRS is pretty strong, and so, but that would be until, similar to Social Security in terms of you just get that for the rest of your life.
Yes, you get it for the rest of your life. That's the deal.
Okay.
Usually, the rationale is something like, okay, you've taken a lower salary most of your career, working for the state, working for the system, and so in exchange, we have this pretty good plan that will guarantee you a stream of income through retirement. Yeah.
I thought I heard that the Texas plan, because it's not part of DPS, so part of it, that there was actually a little bit of a gap funding issue, and I think it was up for the 85th legislature, but it was a recent thing, so I don't know what the result is. I believe Texas has the money, it's just not quite 100% vested where it should be protected one, but it's been a legislature issue, I thought.
Right, it is a legislature issue, so the way that they often correct it is increasing the amount that you as an employee need to put into the system, right? I think this just happened with the TRS system.
So they decrease the employer contribution.
Right.
The percentage match. Yeah.
So someone is doing all of these calculations to see what do they need to be for this to be solvent, right? Are we on track? Are we behind? If you have a long time with low investment returns, then the pot of money that you're drawing out of isn't growing as fast as everybody expected. So, this is kind of a whole thing in and of itself. It's important if you're paying into a pension system to understand this. But it's not. But what we're going to talk about for the rest of the time here today is how to supplement. Even here, if you're receiving Social Security, maybe you're receiving a pension, that's probably not 100% of what you need anyway, right? So then we move down to the other place where you're going to get money in retirement, which is drawing down your voluntary savings or investment accounts. So this is voluntary because you are choosing to put this money aside. Yeah.
Actually, I have a question real quick
Oh,
about Social
yeah.
Security and pensions. So is there anything that we can do to protect ourselves? So for example, I'm probably not going to get Social Security. So should I keep my paycheck? Should I keep something as record? Or if pension, let's say Texas becomes Illinois and they have issues with pensions, is there anything we can do to protect ourselves?
I don't think so.
No.
No. I mean, if that happens, you and everybody else who's paid into the system are all going to have some problems. Yeah. With very little recourse. There will be lawsuits. I mean, don't get me wrong. There will be lawsuits from every interest group trying to get whatever the pot of money is. Everyone wants the first claim on it. But you as an individual, what I would say is if you are concerned about Social Security, concerned about the solvency of your pension, like whether or not it'll exist when you get to retirement age, you concentrate on this number 3. This is what you can control, right? Like you have to have saved up enough extra to supplement it if everything else goes away. And I don't think that when you get to retirement age, I don't think this is going to be 0, the Social Security. I don't think it's going to be 0. I think there will still be, there's a way to make that system work.
Just like a lower percentage of our actual income.
Right, it might be less than what you expected, but I don't think it's going to be 0. So here, like whether you are trying to supplement these other streams of income or replace these other streams of income if you're afraid they're going away. Most of us are or should be making voluntary contributions into retirement plans or other investment accounts. So here, if you work for an employer that has a 401k, a 403b, or a 457, you have to opt in to contributing some of your paycheck into those plans. If you are self-employed or if your employer does not have a 401k or a 403b, then you should be opening IRAs, individual retirement accounts, and contributing to those. Again, you are opting into doing this, which means you have to make the decision to do it. Does that make sense? So let's talk a little bit about compounding. So successful investing starts with 2 basic formulas. So the first, income minus expenses equals savings. This is kind of the realm of personal finance, financial planning. So Dave Ramsey, Susie Orman, like a lot of gurus, where the basics are you're receiving income from somewhere, you have money going out the door in the form of the expenses that you pay to live whatever lifestyle you have, and whatever's left over, this is your savings. It is really, really important that this is a positive number, right? It seems obvious, like yes, don't spend more than you make, but we all know in practice, it's easy to let this slip. Okay, you can't move to the next equation until this is a positive number. So assuming it is positive and the numbers are all working out, what we do is we take that savings and we invest it in assets. Assets is something you own, and it's something that you expect will increase in value. So things like a house, things like stocks and bonds, not computers, not cars, not things like that, right? Those go down in value. We're trying to focus on things that we think will go up in value. So hopefully you start accumulating some assets. You will probably have some liabilities, which is a fancy word for debt. Liabilities. When you subtract your liabilities from your assets, you get your net worth. This, especially if you're just out of school, this might be a negative number. And it might be negative for a long time if you have big student loans. That's okay. This, not okay to start here. You have to fix this first. But the idea is you take this savings, we invest it in assets, then assets, either now or in the future, generate more income. So if you invest in stocks, many stocks pay something called a dividend, which is a cash payment to the people who own the stocks. If you invest in bonds or loans, the person you're lending money to pays you interest. If you're investing in real estate, people pay you rent. So you can have these assets that start generating these little income streams. Your income goes up. As long as your expenses don't go up at the same rate, you should have more savings. Then you take that savings, you invest it in more assets, which create more income, which should create more savings. And we're creating this really powerful feedback loop. This is the loop that you want to be looping, right? If this is negative, you're going the wrong way. Because if this is negative, where are you getting the money? You're borrowing it. Your liabilities are going up. Your liabilities generate interest on the credit cards that you're paying down, right? The interest is increasing your expenses, which might be increasing your shortfall, which increases your debt, your credit card debt. And so you start using this really powerful force in the wrong direction, and it accelerates over time. So we want the acceleration to be going upward, right? Does that make sense? Because if it's going the wrong way, I mean, we all know people who are in way over their head and who have a lot of debt that it'll take them a long time to get out of, if they can get out of it. We don't want to be there, all right? And really, it's the credit cards that are the problem. Are there any questions on that? It gets pretty straightforward. But by saving some of your income, using it to buy assets that we're talking about here, we're trying to create this powerful feedback loop. And this is what compounding is. And it's how people create wealth. So that's what we're here to do. The more time you have, the more powerful the effect. So this leads us into my favorite topic of all time, time value of money. So if you've ever taken Finance 101, you learn about time value of money. This is what everything in finance is built on. Everything. Your amortization schedule for your car loan, your amortization schedule for your mortgage, if you're trying to project into the future what something will be worth, it's all built on time value of money. And there's only 5 inputs in time value of money. We have present value, what something is worth today. We have number of periods. So usually this is years. Sometimes it's months if it's a monthly amortization schedule. Your rate of return. So your rate of return is exactly related to what you are choosing to invest in. And we're going to talk more about that in a little bit. Payment. So if we're talking about retirement accounts, when you are putting money away for retirement, this is a positive number. So this is the amount you're contributing to your accounts every month. So it's a positive number. When you're in retirement, you're taking money out of the accounts. So it becomes a negative number. And then future value, our projection of what something could be worth in the future. So there's only these 5 inputs. So let's say you have $10,000. If it grows for 30 years at a 5% rate of return, how much will you have at the end of 30 years? This is the formula. This is the calculation. You'll end up with $43,219 in that account. Does that make sense? So my favorite thing is to kind of go through these scenario analyses. When you're doing time value of money, you use a financial calculator. You can just Google future value calculator and come up with an online calculator. There's all of these functions are also in Excel, so you can build a spreadsheet to do all this for you. So let's talk about some different scenarios. Let's assume that we're starting with $10,000. Someone just gave us $10,000. And now we're trying to decide what to invest it in. So here in the upper left-hand corner, we're starting with our $10,000, and we found an investment we think that will return 5% a year. We're not going to put any more money in this account. We're not going to take any money out, and we're going to let it grow for 10 years. We plug this into our financial calculator. We come up with $16,289. So that's pretty good, right? You get that extra almost $6,300 just from the growth of your investment. If we go to the upper right-hand corner, now instead of investing for 10 years, we're going to let it grow for 30 years. So we're just letting it in the same 5% return investment, letting it do its thing for another 20 years. When we plug that into our calculator, we get $43,219. This is the example from the previous slide. But this makes sense, right? You let it grow for longer, you should have more money at the end of 30 years. So that totally makes sense. If we come down here in the bottom left-hand corner, we're going to go back to the 10-year time horizon, but now we're going to make a different decision going into it. We're going to say, okay, instead of targeting this investment with a 5% rate of return, we're going to target something that we think has a 10% rate of return. So now we're just changing the rate of return. When we plug that into our calculator, we come up with $25,937. So this makes sense too, right? Like, all right, your rate of return is higher. You should have more money at the end of 10 years than if you had a lower rate of return. So then we come down to this bottom right-hand corner. We're still starting with our $10,000. We're going to stick with that aggressive 10% rate of return. We're not going to add any more money to this account, and now we're going to let it grow for 30 years. So when we plug this into our financial calculator, for those of you who have not seen this example before, does anyone have a guess what this number is?
$100,000.
$100,000. That's a great guess. Anyone else? High? Is that high? Is it low? It's low. It's way low. The number is almost $175,000. So you have these two things working to your advantage: higher rate of return and longer amount of time. So the reason that I talk about this every single time that I talk about this topic, every single time, is because, as an advisor, one of the things I hear all the time is, I'm a conservative investor. I don't want to take too much risk, right? That's great. You can be a conservative investor. You should be whatever kind of investor that you want to be. But if you are a conservative investor and you're not even giving yourself a chance to get these higher rates of return, you need to save more money, right? Someone has to do the work to have the money when you need to have it. You either need to do the work with the brute force of saving it, which means not spending it, or, like most people have to do, you have to ask your investments to grow for you. You're taking a risk that they're not going to grow, but most of us have to take that risk in order to have enough to have the kind of retirement we think we want to have. Does that make sense? The thing you cannot do is say, I'm a conservative investor and I don't save money. You will not have enough. Like, I can almost guarantee that. You will be living off of that 40% income replacement from Social Security, and that's not nice, right? So here, making these decisions, keep all this in mind. Conservative investments, and we'll talk about this, there's not a lot of downside, there's not a lot of upside. That's the way it works. They're more stable. Yeah?
Can you talk about inflation also?
We can, maybe after we talk about all the other, all of the numbers that I'm going to be talking about are nominal rates of return. So, can you ask me about that at the end? We'll come back and talk about inflation. Okay. Someone will remember to ask about inflation because it's a big one. And we'll come back to that. So most of us are doing most of our saving in retirement accounts. So I'm just going to touch on that really quickly. In the class that a couple people alluded to, we talk about all of these topics in way more detail. This is just like the 1-hour crash course in everything, right? So the basics of retirement accounts, the idea is that the IRS is giving you a break on taxes in some way to incentivize you to save money for retirement. So there's really two types of retirement accounts. There are traditional accounts and Roth accounts. So let's talk about traditional first. With a traditional account, you are making your voluntary contribution of money, and this is pre-tax. So taxes are not taken out of this amount. You get to put the whole amount into your traditional account. You put your money in here, you invest in something, it grows and grows and grows, and then in retirement, which according to the IRS starts at about 59.5, you take money out of your accounts, and this is when you pay taxes. So this is a traditional account. It's the timing of the taxation. You don't pay taxes today, you pay taxes when it comes out. The other type is Roth. So with the Roth, the timing of the taxation is flipped. You pay taxes today, So the contributions that go in are post-tax, and you send your taxes off to the IRS over here. Your post-tax money goes into the account. You invest in something. It grows and grows and grows. And when the money comes out, no taxes are owed. So if you work for a company who has a 401k plan, you definitely have access to a traditional 401k. You might have access to a Roth 401k too. Sometimes employers offer those. With a 401k or a 403b or a 457, your contributions are limited to $18,000 a year if you're under the age of 50. If you're over age 50, you can put in $24,000 a year. So this is your voluntary savings, right? And then you can start taking distributions at age 59. If you don't have access to a 401k, then you're going to want to look into setting up an IRA, an individual retirement account. The contribution limits on those is a little bit lower, a lot a bit lower. This year, if you're under age 50, you can contribute up to $5,500 a year. If you're over age 50, you can contribute up to $6,500 a year. The timing of the taxation is the same. Are there any questions on that?
Do you know why it's lower for the individual retirement?
I don't. That's just what the guidelines are. For some reason, if you're contributing through an employer, you have higher contribution limits. Yeah.
For a 401 and a 457, is it combined total of 18 or 24,000?
If you have access to both, which you probably do, that is the holy grail of being able to save, because you can contribute $18,000 to each or $24,000 to each. Like, you're one of the only groups of people who have that option if you also have a 457. It's awesome, yeah, but it's not common. Yeah.
For the traditional 401k, the amount that you're taxed at when you are getting the distributions, that's just like a considered normal income.
Exactly.
So why would someone choose a Roth 401k? Because wouldn't you be at a higher tax bracket, probably getting taxed going in than coming out? Most likely. So
this is always a really hot topic, right? Like, what's the most advantageous way to do things? First, I will say that if you have more than 20 years to retirement, there's no way to gauge what income tax rates are going to be in the future. They're whatever Congress says they are. But people are generally thinking, okay, if I'm in a really high tax bracket today, I want to not pay taxes today and just take a chance that my tax rate will be lower in the future. So they would contribute to a traditional account. If you're in a really low tax bracket today, you would want to contribute to a Roth, because you're paying taxes, but it's just a small amount. And then, whatever the tax rate is in the future, you don't have to pay it at all. Does that make sense?
yeah.
Yeah.
Just going to say, if you've been working for a while and then you want to take off a couple of years, maybe you're going to have kids, or maybe go back to graduate school. You might have been doing your 401k all along, but in that couple of year window where you're not going to be making a lot of money and your tax rate's really low, you might want to do it as a Roth there, because you'll get more bang for your buck.
Yeah.
So it's kind of like, sometimes there are just periods in your life where it's like, I'm just going to do something, and I know for the next year I'm not going to make a lot of money. That's kind of a nice year to sort of start the Roth.
Yeah.
I have two. I have a traditional and a Roth.
Mm-hmm.
So if I need the tax deduction that year, I put it in, and sometimes I split it between the two.
Right.
Just put in what I need to get my taxes down, and then the rest in the Roth.
Yeah.
To the max, each year, yeah.
And that's generally how people do it. Every year, you're like, okay, where am I? Oh, I got a huge raise. I'm going to take the tax break this year. Like, oh, I took a sabbatical. I'm in a low tax bracket. I'm going to do the Roth, because you can go back and forth.
Do you have a Roth 401k or is the Roth?
No, I have, I'm self-employed, so I have the IRA. So I have a traditional and Roth.
Okay, gotcha. I'm just trying to make sure, like,
Yeah.
how did you open up a Roth 401k? So, okay.
Yeah. If you can have both of the two different 401ks, that'd be
a Roth and traditional, so you can use whatever you need.
Yeah, if it's through work, you can usually just go in and change what you're contributing to. Yeah, Tiffany?
So what do you guys mean by tax break when you guys are referring to putting money into the accounts?
Yeah, that's a really, really good question. So here, if we go back to a traditional account. If you are committing to making a contribution somewhere for your retirement, if you are contributing to a traditional and you earn let's say you earn $1,000 from your job. If you're contributing to a traditional, the entire $1,000 goes in here. So there's no tax cost to putting the money in. People think of that as a tax break. This is $1,000 I don't have to pay taxes on today.
Okay.
So when people are saying, I get the tax break, it's if I'm saving money, do I get to save the entire amount that I earned? Or if it's a Roth, you earn $1,000, maybe you have to pay $200 in taxes, so you only get to invest the remaining $800.
So the tax break is that $200?
Yes. If you chose the Roth, you do not get the tax break today. You pay the taxes today. You get your tax break in the future.
So if I open a regular or traditional IRA, and then all I would have to do is write that on my tax returns in order to get the tax break.
Yes.
Okay.
So in an IRA, you tell them how much you put in the traditional IRA, and they give you your taxes back that you paid on that amount.
But I don't do anything with the Roth because I'm paying taxes.
Exactly. Yes. Perfect. Yeah.
Okay, so I have both a traditional 401k and a Roth IRA, and that's just because I couldn't have a 401k for a year. So let's say I do what she said and I do a sabbatical or I have a kid and I have no income technically. What if I wanted to convert some of the traditional money into the Roth so I'm in the lower tax bracket? What are the penalties, restrictions on that?
There's no restrictions.
How does that work?
You call up your broker. Who has your accounts?
At Fidelity.
You call up Fidelity and you say, I would like to convert my pre-tax money to a Roth. And they will send you a form and you'll fill out how much you want to convert. And then when you file your taxes, it'll show up. I converted $30,000 from a traditional to a Roth. Now you'll owe taxes on that $30,000, right? Because it hasn't been taxed yet. You pay the taxes on the $30,000 at ideally a lower tax rate. It moves into your Roth. And that's it. So as of now, there are no restrictions.
And they have a calculator, so you can put those numbers in, and it'll tell you what taxes you're going to owe on that conversion. But you have to do it by the end of the year. You can't wait till April 15th. You have to do it by the previous year, that year that you want to take that conversion has to be done by the 31st of December.
Okay, and then I have one more question on that. So that obviously bumps you up in your income bracket, technically, correct? So I need to look at my income bracket and make sure that I'm within,
Yes.
not to the next one.
So if it's $30,000, you want to make sure you have $30,000 of room before you hit the next tax bracket.
Okay.
Or otherwise, the first 20 would be in the 15% tax bracket, and the next $10,000 would be taxed at 25%. Does that make sense?
Yeah. Thank you.
Yeah. Oh. Great questions. This is awesome.
I have one question about the $18,000 in the 401k. Is that what you contribute, or is that your employer matching also?
Yeah, it's a great question. That's what you contribute as the employee.
Out of your income?
Yes.
Okay.
So this is only what you put aside. Ideally, your employer is putting in some money on top of that, right, via a match.
So if you put in $18,000, the max, and your employer matches that 100%, that would be $36,000 that's going into your 401k.
I mean, that would be awesome if your employer matched that much.
You only
Yeah.
owe the taxes on the 18 if it's wrong. Yeah.
No.
Yeah.
Yeah.
So I could potentially do, if I had the money, do both a traditional and a Roth, and then that way I could get a tax break now and later.
What are you contributing to? Is it a 401k or an IRA or one of each? An IRA. Your $5,500 in an IRA is
Both?
it's both together. So it's you can put in $5,500
Max.
max in whatever IRA you want.
Okay.
You could split it up. You could say, I want $2,000 to the traditional, $3,500 to the Roth.
Okay.
And you can change every year too, depending on what your income is. But you're capped at the $5,500.
Is it usually true that when you're starting out in your career, you're paying less taxes, and so you should focus more on the Roth IRA?
Yeah, that's
That was basically what my dad told me.
Yeah.
When I was starting off and I had no idea what to do. He's like, just put your money over here in this Roth IRA.
yeah.
And I did, but like he was the only one telling me what to do.
Yeah.
Nobody else said, oh, you should be putting your money over here.
Yeah.
So I always wonder, like, what's the hierarchy? Like, maximize your 401k if they're matching,
Yeah. So,
then Roth IRA, and then another kind of IRA.
So if you're starting out, so let's say, so the question is, what's the hierarchy of contributions, assuming that you're just starting out, right? Or you're
You're relatively small and lower in the tax bracket.
right. So what I would suggest, if it were me, or what I did do, if you are in a relatively reasonable tax bracket, right, 10%, 15%, 25%, if I didn't make too much, at some point, we haven't talked about this, but at some point you make too much income to contribute to an IRA. But assuming you're not there yet, so assuming you're an individual and you make less than $118,000 a year. So let's say you make $100,000 a year and you are filing single. I would contribute to my 401k enough to get the match. Then I would come back and max out a Roth IRA. And then I would go back and max out my 401k until you've reached your savings limit, right? At some point you're like, I don't have enough money to buy things, right? Yeah.
Sorry for all the questions.
No, go.
So obviously I'm single right now, and I would convert whenever I had the right opportunity to do so. But let's say I'm married and I have dual income. I have the kid then with no income from me, but income from him. So does that still count?
Yes, then you are filing a joint tax return, and you'll have to look at the tax brackets for joint income.
Okay.
The tax brackets change.
Yes.
So for an individual, it's 22.
Yes, and for a couple who are married, I think it's 184. It might be 185.
So I couldn't file single and say, hey, I have no income and
No.
convert it.
No.
Okay.
You could get divorced.
I'm just trying to figure out strategically when to do some of this stuff.
Yeah,
So-
yeah. You would, so all of these things, like these milestone things, you can do some planning around them. That's what people do. Do some financial planning around these milestone events. It doesn't have to be perfect, but you can at least think about things like that. Okay, my income is going to totally change. I'm going to get a huge bonus next year. I'm going to make too much money to contribute to a Roth, so I'm going to make sure to do that this year. Like all of these things are what you should be thinking about.
Annual income. Right?
What? Say that again?
Bonuses still count against you.
Yes, definitely. Yes. Yeah.
So, let's say, okay, so recently I've been contributing to my pension, which is the TRS, and they just take money out. And I've been doing somewhat okay with my IRA. But the way that I'm seeing the numbers now, it just seems like both the pension and the IRA are like behind the 401k because you can contribute more to the 401k. Does that make sense? Or does it kind of even out if I can continue with TRS and continue with my traditional or Roth IRA?
Say that again?
So I guess it's just a worry, like a personal worry. Because I have TRS and I contribute to an IRA. But it seems like both annually is less than the 401k that I can actually save.
It is. So you're paying into TRS.
Yes.
So are you saying you have more you could save
Yeah.
above the $5,500 to your Roth?
Yeah.
Yes. Okay. So save it somewhere. So here for you, you can contribute to TRS. You can max out your IRA. Then you can open a 403B through, who do you work for? Do you work for UT?
Well, I used to work as a teacher, so I'm in the transition phase right now, so I'm not sure who my next employer is going to be.
Okay, so whoever your next employer is, you will be paying into TRS, but you can also open the school version of a 401k, which is a 403B.
Okay.
and contribute to that.
Okay, so that's the other option, and is that kind of a maximum of $5,500 also?
That's a maximum of $18,000, like a 401k.
Oh, okay.
So if you're thinking, oh, I could actually save $10,000 in these voluntary accounts, you'd pay into TRS, put your $5,500 in your Roth IRA, and then put the rest, the additional $4,500 a year, into your new 403B that you open as soon as you're signed on with a school district.
Okay.
Why do you say put your money into the IRA and then the rest of it into the TRS too?
Yeah, I mean, it probably doesn't matter. Like if you can save more than $5,500, since AISD or whoever doesn't match, they typically don't match, it probably doesn't really matter where it goes. The point is that there would be a home for it. If you can save more money, you're still at that place where you can find a tax advantage place to put it.
Okay. Wait, so if I do a 403B, would that count as a tax break?
If it's a traditional 403B, then you would not pay taxes on that money before it goes in.
403B, you can have Roth. Okay.
Yeah.
Thank you.
Yeah. I mean, because that's a good question. It's, if there's no match at your employer, then, yeah. I mean, at some point, you're just, the point is, we can kind of talk about, the exact right place to put the savings. Like, step one is save it and put it somewhere. And even if you make the wrong decision, it's better than not making the decision, right? Like, just save it, pick something, open an account, and shove as much in there as you can. And, we can always do, a lot of the tax planning that really moves the needle, a lot of it is done as you're getting ready for retirement, right? So the point now, like while you're saving it, is to save it. Yeah.
So if outside of retirement accounts, right?
Yeah.
So one, I'm impressed with the amount of young people asking awesome questions, and like that's awesome. But for me, like thinking about me at this point, right? I can have a heck of a lot in retirement, but I don't want to wait 20 years. My son's now. I want to do stuff now.
Yeah.
And so if I could go back to 20-year-old, we're outside of retirement accounts. I understand getting tax breaks, but where else can you put money so that you're saving for a wedding one day, you're saving for children, you're saving for a house at age 20.
Yeah, yeah.
So because you can't get the money out of there when you want a house.
Right.
You can't get the money out of there when you want to send your kid to private school.
Yeah.
Where else can it live?
So all of that has to go in a regular brokerage account. And it's in your name, and you own it, and there are no strings attached to what you can buy, what you can sell. Just the trade-off is you pay taxes on any gains. So any amount the investment goes up, you pay taxes on the gains. Any dividends you receive, you pay taxes on the dividends. Any interest you receive, you pay taxes on the interest. But you can get to it whenever. You don't have to wait till you're 59 and a half. So for either the extra or I don't want to lock this up until 59 and a half. I'm not willing to do that. Then you just go to Fidelity or Vanguard or Schwab or Scottrade, whoever, and open an account. It says Sara Glakas's and Christian Glakas's joint account. And now whatever you are, you can save that money, invest it in whatever's appropriate, but you'll just owe taxes on the money you make in it.
Yeah, I call my individual account my taxable account.
Yeah. Yes. That's what. Yeah.
Any decisions I make, there's tax consequences every year. Where my deferred and my Roths, there are none until I start taking it out.
Yes.
Yeah.
Taxable account is a good thing to call it.
Taxable brokerage account, yeah.
Yeah.
Which I think is what they call it.
Yeah. Yeah. Yeah.
Sorry.
Yeah.
So I have a Roth IRA, and I was told that I could use that for a down payment on a house if I wanted to. So that's separate from a brokerage account that you're talking about here.
Yes.
So I'd want to instead do that than rather than pull from the Roth.
I mean, it depends. You can make you can take out $10,000 penalty free from your IRA to make a down payment on a house.
Okay.
You can take out up to $10,000 without paying a penalty. If you take it out of a traditional account, you'll owe taxes on it, but not the 10% penalty, because I didn't mention that if you take the money out of your retirement account before 59 and a half, you pay a penalty in addition to any taxes you might owe on it. So you could still do that, yeah. Great. Maybe I'm going to kind of go through these a little bit more quickly so we can get to what are we investing in part of it. But just one more time value of money scenario. So here, let's say you're starting new job, you're starting a 401k from scratch. So the present value of your 401k is 0. And you say, okay, I can put $500 a month into this 401k. And I'm going to plan on doing this for 15 years. So 180 payments into your 401k. And let's say you're targeting a 7% rate of return. So something that's moderately aggressive. Your future value, if you type this all in to your financial calculator, at the end of year 15, you would expect to come back and have an account worth $158,481. If you kept doing it for 30 years, you would end up with almost $610,000. So this is $500 a month. This is making the decision to set aside $500 a month for 30 years and then investing it in something that has a chance to grow quite a bit. So your total investment over the first 15 years, you're only setting aside $90,000, and your account has grown to $158,000. Over 30 years, you've only set aside $180,000, and you end up with $610,000, basically. So that's the power of like these little decisions that you can make today. Man, they pay off over long periods of time, right? Like one of the main things that our more experienced investors say in here is like when you see young people, it's like, save more money and just let it sit there, right? Because it's so much easier to do it at the beginning than it is to come back around. If you're trying to save $1 million to go into retirement, it's much easier with this head start. It's much harder to do over 5 or 10 years. Then it's just the brute strength of saving a lot of money, and that's hard. Does that make sense? So these little decisions add up. So now we've talked about accounts, we've talked about time value of money. So now my second favorite topic is talking about rates of return in different asset classes. So what this chart is showing is risk versus return by asset class. So when I'm saying asset classes, I'm talking about stocks, bonds, cash. The stocks is broken down into large US stocks, small US stocks, and international stocks. And then on this chart, we also have commercial real estate and commodities, which are raw materials, oil and gas, timber, corn, cattle, things like that. Things that get used up. So on this axis, the x-axis, right? Every single time, I forget which one is which, but the x-axis, this says standard deviation of annual returns. So in finance, standard deviation is a measure of risk. On the y-axis, it says compound annual return. So this is our R. So these are the actual return numbers for these asset classes, including inflation, so not adjusted for inflation, from 1970 to 2016. So a 46-year time horizon. That's a long time. But if you go back to 1970 through 2016, these were the actual returns for these asset classes. That's what's on the y-axis. The x-axis, the standard deviation, is showing it's a measure of volatility. It's a measure of, from year to year, what your actual returns might have been each year. Does that make sense? So if we're looking at commodities, here, the R, the compound annual return over 46 years, was 7. But in any given year, during those 46 years, your rate of return could have been 32%, or it could have been negative 18%. That's a really wide range. Does that make sense? You know, at the end of 46 years, the compound average growth rate was 7. But in any given year, it would not have been 7. It would have been something wildly high or wildly low. And you take that versus cash, over 46 years, your rate of return would have been around 5. This is back when cash accounts, like savings accounts, paid interest, right? It's been a while, but it did happen. So your rate of return would have been 5. Your standard deviation was very low. So sometimes that rate of return would have been 5. Some years, maybe it would have been 6. Some years, maybe it would have been 4. The range of outcomes would have been a lot lower. Does that make sense?
Yeah.
So we can see this for all these different asset classes. Down here in the bottom left, these are safety assets, safer assets. Cash, US bonds. Bonds are just making loans to companies or countries, cities. But the idea is I'm lending you $1,000, you're going to pay me interest on that $1,000, and then at the end of this loan period, you're going to give me my money back. You're going to give me my $1,000 back. So it's a pretty safe arrangement. Over here with stocks, which is ownership in companies, it's a lot riskier. If you own Apple, the way the stock market works is if Apple is really good at generating profits, you expect the price of Apple to go up. If it is not that great at generating profits, you expect the stock price to go down, right? So the prices of stocks goes up and down pretty wildly depending on the economic situation, depending on how confident people are, depending on interest rates. There's any number of things that get baked into the stock market. So there's a lot of volatility, but over long periods of time, you get a higher rate of return. So it's that risk-reward trade-off. So over here, over the 46-year time horizon, large US stocks returned about 10.3, 10.4% on average, right? But almost never actually 10%. It's either 25% or negative 10% or negative 20%, all kind of averaging out around 10.3. Does that make sense? So here with international stocks and commodities, you were out here taking a lot of risk, you were seeing a lot of price fluctuation, and over that period of time, you didn't really get the return that you were hoping for. You were taking a lot of risk with not as much return as if you'd kind of concentrated on US stocks. And some of that has to do with currency fluctuations. We're approaching this from being investors in the US. We earn money and pay money in US dollars. If you're investing in companies overseas, you're translating currency from other currencies into dollars, so you can get gains and losses from that. So this is what, with those original scenario analysis calculations, this is where kind of the 5%, 10% number comes from. And back to the inflation question, over this period of time, inflation was about 3.5% on average. So your cash accounts, if you earned 5% and 3.5% of that was eaten up by inflation, your actual return was about 1.5%. With stocks, if you earn 10% and about 3.5% of that is eaten up by inflation, your actual benefit is about 6%. Stocks are great to own during times of inflation, as long as the inflation isn't crazy. If it's just normal rates of inflation, stocks are good inflation hedges. So this is where those rates of return numbers are coming in. Does that make sense? The red dot, this is what we talk about in Investing for Beginners, the class that I teach. The red diamond is showing that if you took all 7 of these asset classes, put them in one portfolio where you owned 14% of each of these asset classes, there's kind of this magic of a diversification in investing. If you don't have all of your eggs in one basket, it's a really cool thing happens where you get almost as high of a return with much less risk than if you had, for example, just invested all of your money in stocks. So if you're 100% S&P 500, 100% large US stocks, you'd have gotten 10.4% with a lot of volatility. But if you had a diversified portfolio with some bonds and some cash and some commodities and some international stocks, you would have gotten like a 9.8% return, but with much less volatility from year to year. We won't talk about that too much here, but it's important.
Mutual funds that we're talking about?
So you can invest in any of these asset classes through mutual funds. So yeah, there would be any number of mutual funds that would focus on one of these asset classes. If you are investing in a 401k, you probably have a list of target date funds, right? You say, I want to retire in 2040. You have one fund, and in that fund, they are making the decision about what your allocation is to each of these asset classes. So if you want to retire in 2040, you're probably something like 80% stocks, 20% bonds. If you were in 2020, your allocation's probably closer, something like 55% stocks, 45% bonds. Because as you get closer to retirement, most people don't want to be exposed to that wild volatility, right? Because a year from now, you're retired, you're pulling money out of your accounts. Do you want a whole bunch of your portfolio to be down 20% in a bad year? Most people do not like that, right? If you're not close to retirement and the market's down 20%, hopefully you're still contributing, so now you're buying stocks cheaper. Or if you kind of lose your nerve a little bit, at least you can say, I can wait it out. I can just wait. Great questions. Are there any other questions on kind of this risk-reward profile here? So again, past performance is not indicative of future results, but these are what the actual numbers were. So can we use them going forward? If you take anything away, it's if you want a higher rate of return, you're going to have to take quite a bit of risk. But you can use diversification to your benefit there too. So this is why we do it. Why do we invest in stocks? So this is a 10-year chart showing the S&P 500, which is 500 very large US companies, versus a pretty stable bond portfolio. So this is a 10-year chart. We're kind of at this point in time where now 10 years ago, we're getting to if you think back 10 years ago, it's when things really started hitting the skids, right? It's like the beginning of the financial crisis 10 years ago. So if we go back 10 years ago, if you'd invested in the stock market, your timing was no bueno, right? You start investing in the stock market, and it pretty much immediately starts going down. You're like, oh my gosh, like what am I doing here, right? And if you'd invested in a really safe bond portfolio, you're thinking, okay, it's not growing, but it's not falling, and that's something. But zooming out over 10 years, even after the second worst financial disaster in the United States, 10 years later, the pink line is stocks. The stock market came back, and the bond market just chugged along, right? So most of us, we need exposure to this pink line. And maybe you're not just the pink line, 100% stocks. Maybe you're somewhere in between. If you have a 50-50 portfolio, your line is between these two, right? If you're in an 80% stocks, 20% bonds portfolio, you're kind of hovering above the pink line when it's down, but now you're below the pink line when it's up. So you have to figure out, okay, where do I want to be here? And if you're saying, I want to be the green line, I don't want any of this crazy volatility, you're probably going to have to save more money than you are to get where you want to go. Does that make sense? So here again, this is a 10-year chart of the stock market, just to kind of re-emphasize what we just talked about. If you had started investing in stocks 10 years ago, you were right at the beginning of a 16-month decline where your stock investments would have lost almost 53% in 16 months, right? That is falling really far, really fast. And this is absolutely what you need to fear and respect in the stock market. These things happen. Hopefully not something that severe again, but these things happen.
Wouldn't that be when you want to buy more stocks though?
Yes.
fell.
If you're in the Austin Women's Investing Group, yes, that is the right answer, is you start kind of hoping that the stock market falls, right? But when you're in it, it's not that easy. When you're actually in it, you're thinking, I have made the wrong decision, right? So we're starting this horrible decline over 16 months. It took 5.5 years to basically get back to where you started. So the original decline and then the long time getting back to where you started is where people get frustrated, and it's where people throw up their hands and say, never again. I'm not going to do this. We all know those people, right? Like, I'm done with this. But companies in the United States figure out a way to make money. Whatever the environment is, someone's going to figure out how to make money from it, and that's what the stock market is. So we've got a recovery, and it's slow, and it's painful. They call it climbing the wall of worry, right? You can see it like, oh, nobody's quite convinced that it's happening, but then it happens. And so if you were lucky enough or brave enough to have started when the market was 50% down, you are at a 264% gain in the market over the last 8.5 years. That's pretty good, right? This is what the stock market looks like. You will be exposed to these crashes or corrections, whatever you want to call them. The stock market falls all the time. But if the past has any good information for us, it's that so far, the stock market has always come back. Sometimes it takes a while, but it's always come back. So far, no guarantees. Are there any questions on this?
That particular decline, though, was unusual.
It was unusual.
We're used to more of those other smaller declines.
Right. So a normal decline, a normal bear market, that's what, a bear market is what most people are scared of, is a 20% decline. And that's not unusual. People would be like, yeah, this is scary, but it wouldn't be, most people wouldn't think it was abnormal, right? Bear markets will happen, and that's a 20% decline. A correction, which used to happen all the time, is a 10% decline. So if your accounts are down 10%, normal. If they're down 12%, 15%, 20%, expect those things to happen. And hopefully you view it as a buying opportunity because you still have 10, 20 years to wait for the market to come back. There haven't been that many declines recently. There have been very few 1% declines in the stock market this year, which is unusual. Do not let that lull you into a sense of complacency, like this is easy money. It's not. Right? Something will happen. I don't know what it is. And also don't make the mistake of thinking that you're going to be the person who gets out of the stock market here and gets back in here.
Yeah.
It is impossible. Don't try it. Don't even ask a question about it. Okay? If someone tells you they know, do not trust them. Nobody knows when these things are going to happen. Or maybe you went out of cash. Maybe you were lucky enough to go to cash here and then you bought back in here. Right? When you're investing in stocks, the best thing, the absolute best thing you can do is put in contribution every month in your 401k for the rest of your life, right? Because sometimes you're buying stocks here, sometimes you're buying your stocks when they're at half price, and you're putting in a little bit of money all the way. It's a lot more difficult if you have a lump sum you're starting with, an inheritance, a windfall of some sort, and you're like, oh, I have $100,000. What do I do with it? If it really has a 20-year time horizon on it, maybe the answer is put it in the stock market and forget about it for 20 years. That's probably going to work out pretty well for you. If you're not quite there yet, it might be take your $100,000 and break it into $10,000 chunks, just in case we're here. 10,000 here, 10,000 there, 10,000, 10,000, 10,000. All right, now I'm in. So there are some strategies for that, but if you're in, if the money that you have is earmarked for something 10, 15, 20 or more years down the road, the stock market is probably going to do it for you over that period of time with a lot of bumps. But
so, if not that we're going to go to war or anything, but if something happened and we went to war, would that would like influence this?
sure, yeah.
Positive or negative?
We'll see. I have a chart.
Oh, there you go.
We will get there.
Decline this
Yeah.
week when the North Korean.
Oh, yeah.
Stock market decline, and then
Yeah.
it came back the next day,
Yeah.
and then it.
Yeah.
And then the Spain thing happened this week, and it dropped to 1%, and then
Yeah.
it came back the next day.
Exactly.
Yeah.
Yeah.
Yeah. I mean, again, like zooming out over the long run, this is going back to 1950. I mean, the market goes up, the market goes down, the market goes sideways. Over this time horizon, your rate of return, your R, 7.6% over that time period. That's pretty much what we're talking about. Plus, you would have received dividends from your stock holdings over that period of time, maybe 2.5%. So we're getting back to that 10% return number. So the stock market kind of keeps coming back to that number. It doesn't mean it's always going to be that way, but there is, keeping 10% kind of in your mind and maybe giving it a haircut in your own mind. Like maybe it's not 10, maybe it's 8.5. What are your expectations going forward for your return when you're doing your present value, future value calculations? Yeah.
Another question. So, if you're making some money, is it better to reinvest it or put it into a cash reserve? I'm seeing that in both places.
Yeah, so it depends on what your plan is. Do you need the money? Are you going to need it in the next 5 years? Any money you might need in the next 5 years, not the stock market, right? So if you're like, oh yeah, I'm going to use this to supplement my retirement income, then don't reinvest it. Keep it, start putting it in a little cash stash. If you're thinking, okay, like these stocks, I'm really not planning on touching this part of my portfolio for 20 years, then reinvest it. Yeah, because your dividends that you're receiving are reinvesting, even if the market falls, at a lower and lower price. So if there really is a 10 or 20 year time horizon on that part of your portfolio, reinvest it. It's easy. It's easy to just, now you're accumulating more and more without even thinking about it.
And if it's a stock that is doing well, like maybe Apple or Oracle or something like that, that's okay. And then if it's one that doesn't, like HP, then you don't.
Maybe, yes.
Okay.
I mean, you can get as granular as you want. Yeah.
I know in my taxable accounts, my tax deferred, I reinvest, but in my taxable account, I put it in cash, any dividends, to pay the taxes that year.
Oh,
Then,
that's
at the end
good.
of the year, I can buy something, I wait for the market to go down, then I get ready to buy something with what's left over. And then I start putting the dividends back into cash.
That's really good.
And
That's
then
it.
just that's in the taxable one.
Yep.
But the tax deferred, I would reinvest.
Reinvested.
Yeah.
That's great.
Just, yeah, that's why I do it, yeah.
So speaking of uncertainty and crises, this is just a chart showing, going back to 1957, all of the crises that have happened since then, right? So the Cuban Missile Crisis, that was pretty bad in 1962, down here. In 1987, we're coming up on the anniversary of the stock market falling 20% in a day. Not normal for it to fall 20% in a day, but it did happen. So that was bad. Persian Gulf War, World Trade Center attack in 2001. There's all of these crises that have happened, and there are all of these crises that are going to happen. So again, like the stock market is ownership in companies. Whenever the economy evolves, some companies grow and some companies die, right? But someone is going to figure out how to make money from what we spend money on. Does that make sense? So this is a chart of the S&P 500, 500 very large US companies. A few of those, they might die. They might go to zero. They might go bankrupt, and they'll be replaced by someone else, right? So if you happen to be in a fund that owns 1% of Enron, if Enron fails, or Kodak, right? Or whatever the new technologies are coming that are going to wipe out old technologies. being diversified in the stock market is important. So you don't have all of your stock holdings in 1 or 2 or 5 companies, because if one of those does something bad or isn't evolving fast enough, that's when you can really lose a lot of money and it's gone forever. The S&P 500 very large US companies, most of those companies are going to figure out how to make money. And if they can't, they're going to be replaced by someone who does. Does that make sense? So with crises, like, they can be opportunities. If the future is like the past, then crises are actually opportunities. Kind of hard to train yourself to think like that, but it's been true so far. Brexit was a 4-day opportunity. 4 days, right? It seemed like such a big deal. The market fell and bounced back in 4 days. The unexpected presidential election in November was supposed to be a catastrophe. It was a market crash of about 12 hours that had just run its course by the time the market opened on November 6th. Is that right? Whatever the next day was. 8th, 10th, whatever day it was. You know what day I'm talking about. Whatever that Wednesday was. So, sometimes crises, it's interesting, like, if everybody knows what's happening, sometimes the stock market reaction is more muted if everyone knows what the problem is, because now everyone can kind of make a recalibration. Sometimes the scarier ones are when no one knows what's happening, right? Those are the scary things, when you're trying to figure out why the market is going down and no one has a very good answer and people just start freaking out because they don't know. So, but again, even if you don't know, opportunity. And here, this is really the last thing I'm going to talk about, talking about stretching out your longer time horizons. I think this is a cool statistic. So looking from 1926 to 2015, if you'd been a daily investor, you would have been up about 54% of the time, down about 46% of the time. So it's a coin flip. The market might be up, it might be down, if you're just investing over a 1-day time horizon. But as you stretch out your time horizon, your chance of making money goes up by a lot. And to date, there has never been a 20-year time period where you did not have a positive return in the stock market. Maybe it wasn't 10% on average, but it wasn't less than 0. So you can put the odds in your favor by stretching out your time horizon and being patient and being brave when others are afraid. That's a Warren Buffettism, right? Be greedy when others are fearful, and fearful when others are greedy. So you can just kind of put the odds in your favor, just kind of thinking through these things. So choosing investments. I think the way to approach it is asking yourself 2 questions. First of all, when do I need the money? Second, can I tolerate big swings in price? Stocks have higher returns over time, but the price bounces around a lot. Bonds have lower returns over time, but their prices are more stable. Which one is the one you can live with? Or is it a combination of the 2? Stocks require a very long holding period. So we've been talking about decades, right? That's really what it is. If you are going to need some money in 5 years, do not put it in the stock market. I get this question fairly often. Someone says, I want to put a down payment on a house in 2 years. Should I put it in the stock market? My answer is always no. It will always be no. If you come back in 2 years and now your down payment is worth 20% less than you thought it was going to be, that's a lot less house you're going to be able to buy. And if your dream is really to buy a house, save up that down payment and put the down payment in something safe so that you know what you're dealing with. And then figure out, and this is, doesn't have to be solved today. It can be, over a lifetime, figuring out what percentage of stocks versus bonds makes the most sense for you. So we'll go back and talk about and do questions for the next 20 minutes, but just so you guys know, kind of next steps that are on the calendar. I'm doing a little office hours on August 29th at my office. So the idea of this is, if there's something here where you have a specific question you want to bring to a small group, come to my office and we'll talk about it. So it can be anything. It can be, I'm looking at this specific stock. Do you know anything about it? It can be, I really want to open a Roth IRA, but I don't know how. Bring your computer. We'll open it. You can bring a portfolio and ask questions about, is this the right portfolio? Should I make some adjustments? Whatever your investing question is, it's a way to kind of take a larger group and make it a smaller group with specific questions. Does that make sense? I really can only fit about 6 people around my conference room table, and that's going to be a tight squeeze. But if you can commit to coming, send me an email. So my email address is on there, sarah@blackburnfinancial.com. And we'll try to get a room full of people who are there to kind of solve some problems, right? Make some decisions. Investing for Beginners, the class is starting through UT Informal Classes. It starts in September 2017. So here's the link to the class. I think there are still slots available, but it does typically sell out. So there are about, I think there's 25 students, and we go through all of these slides in more detail. Our September AWIG meeting's coming up. So again, it's planning, money, and kids. So that's on Saturday the 16th here from 2:30 to 4:30. Caitlin Meredith, who is an AWIG member, she's going to kind of lead the roundtable discussion. So if you're figuring out how you're going to put this kid through college or what your strategy should be, come to the meeting, and it's going to be kind of a swapping of strategies. This is what I did. This is what I'm thinking about doing. This is how I'm viewing it. So it'll be a really good one for solving that specific issue. And then I'm doing an introduction to the stock market class, again through UT Informal Classes, and that starts in November of 2017. So you can sign up now. Again, they tend to sell out. So if you are interested in kind of doing a deep dive on these topics, please sign up for the class. I don't know, it's I love teaching it. I think people like taking it. So kind of want to give everyone here kind of first dibs on getting a slot. All right. And so we have time for questions. We can go back to anything or talk about new stuff. Yeah.
One quick question and then 2 quick questions, I guess. So the first one is for September. I don't have children right now, but I would like to one day. Should I still come? Would that be helpful?
Sure.
Okay. And then the next one would be just a quick summarization, because I want to make sure I got the basics down of what at least I got today. So after I have some money saved, I can invest it in Roth or an IRA, like a Roth or a traditional IRA, 401, whatever. And in that Roth, in that IRA, I can choose a specific asset class, right?
Yes.
Okay. All right.
Which is almost always through a mutual fund, right? A mutual fund it's a company that's set up, but you can envision it it's a basket.
Okay.
And in the basket, it owns a bunch of stuff. So probably a bunch of different stocks. So an S&P 500 mutual fund owns the 500 stocks that are in the S&P 500. A mutual fund that owns the total stock market probably owns about 3,500 different stocks. So it's a way to get instant diversification, right?
Buying the name mutual fund of S&P 500.
Yes,
okay.
Yes. So, and you could buy a mutual fund that just owns a bunch of US bonds or a bunch of international stocks. And really, these target date funds it's one fund that owns a bunch of different funds over different asset classes. So the target date retirement funds, Vanguards, are great. It is truly one-stop shopping. If you buy this Vanguard 2040 fund, you own US stocks, you own US bonds, you own international stocks, you own international bonds, you have some cash in there, you have all of your asset classes kind of baked into one mutual fund.
Is there a minimum that you have to have in order to buy the Vanguard 2040?
I think it's $3,000 to start.
Okay.
Cindy Orman doesn't like those.
Yeah, why doesn't she like them?
No, that's what I was wondering.
Yeah, I mean,
I think if you did it on your own, for instance, if you had a lot of time like I do, and you think, okay, 80% stocks, 20% bonds this year, you could do it, you could make your choices, and it might end up you could get things with lower fees, but it also means that every few months you have to make sure, okay, now that I'm getting older, I want 79% stocks and 21% bonds.
With it all the time.
So you're playing with it all the time. So I think there's, a lot of people say that the fees can be a little high on them, or they wonder if they're, really as good as they say unless you did it your own.
Oh.
But for people who don't want to spend every living, waking hour battery balance for retirement, You know, and especially like a Vanguard, which is going to be the lowest fee version.
Their fees are
There's
low.
some mutual funds that really do charge.
The Fidelity ones, I think, are too pricey.
They can be a little
And don't do it
pricey.
through an advisor.
Right.
Because they add more fees
And then
on there,
there's a
just
fee
do
on
it
top
just
of that.
by yourself for real cheap, like under 0.20.
Right.
But you can also buy balance fund too, which does stocks and bonds, which is
Exactly.
even cheaper, and that can be active or index fund.
Right.
So you could have either between those. Those are sometimes a pretty good deal and better returns than those
Yeah.
bank accounts. So traditional asset allocation funds. So.
And one of the things that I've really come around on, you know, kind of starting with the Susie Ormans of the world, is I see people, I mean, from doing this since 2011, I see people hit roadblocks. And I'm not saying all women are like this, but I'm saying some women are perfectionists. And you think, I'm not going to invest until I've got my plan. I got to get my plan together. I've got to solve, I have to make sure it's exactly the right thing to do, and then I'm going to do it. And imagine how well that works out. How long can you put together an investing plan? It could take you 5 years, right? You know, it can take you, you know, and those 5 years can be valuable 5 years that now the market's running away from you. So for this group, I mean, do something, right? Whatever you're going to do, it doesn't have to be the exact right perfect choice. If it's a Fidelity target date fund instead of a Vanguard, it's okay. Just pick it. Just pick something and move forward, right? And then we can work on optimizing and making it really efficient and making sure it's exactly right as we go, right? It doesn't have to be perfect right this very second, but time is money, right? Like now we know your time is valuable. So don't wait until you have this super perfect plan that's going to work out in every situation. Just pick something and then send your money there. You know, a lot of investing is learning by doing. You know, I can sit here and say like, oh, this is really hard and this is really fun and this, you know, but you will not know until you're doing it where you are and what you can kind of ask of yourself too. So we're just doing the best we can.